Let me give you a reality check. If we continue consuming our natural resources like we are today, we will need 1.8 planets, and by 2040 could be 2.3 planets. And worldwide, only about 7% of the materials used are recycled products. So our recycling and consumption are not in sync, which creates an opportunity for us as investors, as this sector has significant room for growth. This industry is expected to grow from $552 billion in 2024 to $768 billion by 2029, reflecting a solid CAGR of 6.8%. To understand the opportunities in this sector better, we have two types of businesses in the Indian metals recycling industry. Both are generating profit from recycling. First, we have the metal scrap business, where two prominent players are leading the charge: Gravita and Pondy Oxides. Gravita India Limited focuses on the recycling industry, turning used materials into new products. Its core business includes recycling lead, plastics, and aluminum, and it also offers turnkey solutions for lead battery recycling and non-ferrous metals. The company has the capacity to produce about 334,000 metric tons of recycled materials. Pondy Oxides is another key player in recycling, specializing in non-ferrous metals and plastics, with primary focus on lead, copper, plastics, and aluminum. It has a production capacity of 132,000 MTPA of lead. But to recycle metal, they need scrap. How do they procure it? Both companies have similar strategies for sourcing scrap. They don't rely on just one region. Instead, they source from both domestic and international markets to keep their recycling operations running smoothly. For instance, Gravita runs 33 of its own scrap yards and has built an extensive network with over 1,900 touchpoints around the world. On the other hand, POCL sources material from over 70 countries and works with more than 270 suppliers. Because of these widespread connections, both companies can collect scrap more efficiently and cost-effectively, reducing logistics expenses and ensuring a steady flow of raw materials. The metal that they recycle the most is lead. But why lead? This metal is highly recyclable. In fact, recycled lead accounts for 50% of the world's total lead production, and India's production capacity stands at 2.1 million metric tons per year. Government policies are also driving demand for lead. The Battery Waste Management Rules 2022 and Extended Producer Responsibility mandates are significant catalysts for India's lead recycling industry. These rules make battery producers responsible for collecting and recycling used batteries, banning disposables in landfills, and requiring a minimum use of recycled materials in new battery production. OEMs are already using 30 to 40% recycled lead, with targets likely rising to 70%. This push has increased domestic scrap availability. Earlier, companies like Gravita and Pondy Oxides had to source most of their scrap internationally. For example, Gravita saw a 60% jump in domestic sourcing, with 30% in FY24 to 43% in FY25. This means the lead time from procurement to factory has been significantly reduced, almost to zero. Similarly, POCL reported a sharp increase in domestic scrap, accounting for 37% of their procurement in a recent quarter. And that's not all. Stricter GST enforcement and the reverse charge mechanism, or RCM, are nudging the recycling industry towards formal players like Gravita and Pondy Oxides. In FY16, only 20% of the lead recycling industry was controlled by formal players. By FY25, that figure increased to 40% in an industry valued at 12,000 crore rupees. This share is expected to reach 75%. But they are also diversifying their metal recycling portfolios. Both players are adding more metals in their portfolio, with lead continuing to yield the best EBITDA margins. For Gravita, the non-lead segment contributed around 12% of revenue in FY25, but the company aims to increase this to 30% by FY29. The company is making significant investments in its new verticals. By FY28, the company is planning to increase its capacity to around 7.28 lakh metric tons, which now stands at 4.46 lakh metric tons. Meanwhile, POCL plans to reduce lead's revenue share from over 95% to 65 to 70% by FY27, signaling a clear shift towards diversification. Both companies are moving towards recycling more metals, which will help help create additional value for them. Now let's check if these tailwinds are reflecting in their financials. Both companies have been growing at a rapid pace. Gravita saw 23% CAGR in sales over the last 5 years, while POCL's growth was slower at 11%. Moreover, both companies have more than doubled their profit growth relative to sales. Gravita's 5-year profit growth stands at 49%, while POCL's is 31%. Gravita's revenue rose by 22% to 3,869 crores, while POCL's grew by 33% to 2,057 crores thanks to increased volumes and tailwinds discussed earlier. On the cost side, the largest expense for both companies, raw materials, saw significant increases. Gravita's material costs rose by 24% to 3,175 crores, and POCL shot up by nearly 40% to 1,844 crore rupees. Operating profits grew for both companies, but margins were under pressure. Gravita's operating profit was up 11% to 324 crores, though the margin slipped slightly from 9 to 8% in FY25. POCL's operating profit rose to 104 crores and margins remained flat at 5%. Both below the operating line, finance costs came down for both. Gravita's dropped by 12% to 43 crores as the company deleveraged its balance sheet, while POCL's debt was reduced by 29% to 12 crore rupees. Depreciation fell by 23% for Gravita, but rose by 26% for POCL. All these factors combined, net profits improved significantly. Gravita's net profit rose 29% to 313 crores, with net margins inching up from 7.7 to 8.1%. POCL's net profit almost doubled, up 82% to 58 crores, and net margins improved from 2.1 to 2.8%. Gravita enjoys a higher margin as the majority of scrap is sourced domestically, while POCL sources its scrap internationally, which creates a major difference. Now let's take a look at the balance sheets of both the businesses. Gravita saw a jump in its reserves by over 150% following its QIP of 1,000 crores aimed at acquisitions and inorganic growth opportunities. The company also significantly deleveraged its balance sheet, reducing debt by 47% YOY from 548 crores in FY24 to 268 crores in FY25. POCL's balance sheet also showed a massive growth in reserves. Debt significantly increased, but the debt-to-equity ratio remains low at 0.17, which is well within acceptable limits. The company's CWIP rose from 8.9 crores to 75 crores in FY25. For those unfamiliar, CWIP, capital work in progress, refers to the accumulated costs of assets under construction, which are temporarily held until they are capitalized as fixed assets. In terms of cash flows, Gravita's OCF grew from 42 crores in FY24 to 282 crores, a significant jump. However, the base was lower in FY24 and the company made 200 crores in FY25. POCL, on the other hand, had a CFO of 79 crores, down from 64 crores last year. POCL recorded a negative cash flow from operations despite achieving good growth numbers, which was majorly on account of massive jump in inventories and trade receivables. Now let's move on to the second type of business, where opportunity is opening up. We generate waste, a lot of it. Around 77% of untreated waste in India is dumped directly into open landfills. Only 30% of 75% recyclable waste is being recycled. One more fact, we don't process our waste properly. In India, 77% of waste ends up in open dumping untreated. Globally, landfills are preferred methods of managing waste. This is a common issue with garbage piles visible in nearly every city. The government is seeking solutions to tackle this issue. This is where the waste management industry enters the scene. India's waste management industry is worth only 45 billion rupees compared to the global market size of 35.5 trillion rupees. This industry is relatively new in India, but the factors above show the massive opportunity the sector holds. Let's look at the sector through the case study of Antony Waste Management. Antony Waste is one of India's leading players in municipal solid waste management space with nearly 20 years of operational experience. The company primarily works with municipal corporations across Tier 1 and 2 cities, handling everything from waste collection to processing and disposal. They generate revenues by collecting and processing waste, waste, their operations are broadly divided into two segments: collection and transport of municipal solid waste and processing of municipal waste management. The first segment involves door-to-door collection from homes, markets, slums, and bulk generators using a fleet of compactors and tippers and dumper placers. Once collected, the waste is transported to processing units, transfer stations, or landfills. With GPS-enabled fleet of over 2,300 vehicles, they handle more than 6,700 tons of waste daily across residential, commercial, and industrial zones. This segment accounts for the bulk of the company's revenue, around 61%, and has been growing the fastest. What makes it especially profitable is that in many cases, municipal bodies fund the capital expenditure, allowing the segment to operate at higher margins. The company manages 17 projects under this segment. The second part of the business is processing municipal waste, where they handle everything from waste segregation to composting and recycling. In fact, FY25 turned out to be their best year yet for compost sales, which rose sharply from 4,500 tons to over 21,000 tons. Another key product is RDF, refused derived fuel, which is made from non-recyclable waste and has a high calorific value. This RDF is mainly sold to cement companies as a cleaner alternative to coal. Antony Waste also operates India's largest integrated waste management facility in Kanjurmarg, Mumbai, handling about 90% of the city's total waste. The company is also running initiatives in waste processing, such as waste-to-energy plant, processing 700 tons per day of non-recyclable dry waste, producing approximately 14 megawatts of power. This plant generated 62 crores in FY25, accounting for 6.64% of total revenue. And the plant was commissioned in FY24. Another key initiative is biomining, which recovers useful materials from old landfill waste through mechanical and biological methods. Biomining helps reduce waste volume and toxicity while reclaiming valuable land. For Antony Waste, biomanaging is an important area. The company is also diversifying into areas of end-of-life vehicle scrapping, tire recycling, plastic waste management, and e-waste. In FY25, waste processing emerged as the key growth segment with a 25% growth in revenue, while collection and the transport segment with 61% of total revenue saw only 4% growth, and the remaining 12% of revenue comes from mechanized sweeping projects and the sale of scrap. Now you have a sense of how this industry is evolving. Not just collecting waste, but unlocking multiple revenue streams. Antony Waste has an order book of 8,300 crores as of Q4 FY25, around 58% of which is to be executed by 2040, and the rest will be executed in the next 12 years. Let's now take a look at their financials. The company has seen healthy sales growth of 16% CAGR over the past 5 years. Profit growth has been almost the same at 15% CAGR. However, in the last 3 years, their sales have grown at 13% CAGR, while profit has just been 1%. We can see the same trend in their performance in FY25. Revenue grew modestly by 7.8%, while net profit increased by only 0.8%, indicating lower margins. Comprehensive financial analysis: FY25 versus FY24. Sales growth didn't translate into profits. Operating profit grew by 8.7% to 195 crores. Margins were squeezed due to rising depreciation and interest costs from new projects. The higher debt raises a question: is the company over-leveraged? The debt-to-equity ratio stands at 0.7%, which is under the limit. Now let's talk about the balance sheet. We found that trade receivables are increasing, which is a risk for the company. They primarily deal with the government municipal corporations, which have bureaucratic procedures that may delay payments. The company's cash flow from operations grew from 140 to 187 crores, and its free cash flow was negative 14.4 crore rupees. And if we look at the company's cash from operations to net profit conversion, then we can see that the conversion rate is quite volatile. But the median CFO to cash flow conversion for the last 10 years stands at 78.5%, which means in longer term, the company has been able to convert 78% of net profits to cash. So that wraps up our analysis of these three companies, where waste is literally turning into cash thanks to policy-driven tailwinds. One thing is clear: India's waste problem is real, and fixing it creates a huge opportunity for players like POCL, Gravita, and Antony Waste. waste. But with so much of the sector's demand riding on government policies, it's worth keeping an eye on whether recycling can stand on its own in the long run. What do you think about the recycling sector's future? Do share your thoughts in the comments section below.